our market master for the day is Dhiraj Agarwal, Director Institutional Equities at Standard Chartered Bank. Thank you very much, Dhiraj, for joining us. First, what's the call on the macro market itself? It's facing a little bit of resistance at this point in time, but before the year is out, you think 8,000 is here?
First of all, let me tell you, I was quite fascinated to hear you just 30 seconds back.
Okay.
Nalco of 6.5%, not very large. clearly shows the change of mood which has happened in the market, where a 6% move in a large cap name is not considered to be large. And 0.5% up move in the Nifty is considered to be as flat as it goes. So, no, it's nice to see that positive sentiment after 4 extremely tough years in Indian markets. And I think the disconnect between index and the individual stocks at this point of time is because of the rotational nature of the market, as money is moving out of some of the defensive sectors into more economy sensitives and cyclicals. And because of what happened in the last 4 years, the defensive sectors now form a larger percentage of the benchmark indices. So your top 2 weights in Nifty today are ITC and whatever, tech names, etc. Which is what is showing up at the index level. But as you rightly said, the broad market is looking very good. The broad market is actually moving up at a reasonably fast clip. And I'm quite optimistic on the market going forward from here.
Dhiraj, hi, good morning. Good to hear so much optimism. I mean, we haven't heard this kind of optimism from many of you for a very long time. So that's a big relief. But do you think the base for this market has moved much higher now? And where do you see the floor for this market at this point in time?
I think 7,000 odd, maybe 6,800 odd. I don't see the market dip below that in any meaningful fashion. So yes, the base has moved higher. When 63, 6,400 was pretty much the top end of the last 5 years range, and the market has moved sort of above that. So that the top end of that range should now form the base in case something untoward happens. But more than the index levels, if we talk about the valuations for the time being, I mean, despite this sharp run, we are still at 14.5, 15 times FY16 earnings. And with positive sentiment on the economy and economic policy and the government, I think the valuation range of the market will shift vertically upwards. So in the last 4 years, whereas the valuation range was more like 10 to 11 times at the low end, 14 to 15 times at the high end, it is probably now shifting upwards to 14 to 15 times at the low end. And at the high end, 1 or 2 years out, we can scale back to 18, 19 times as well if things go right. So the moment you start thinking like that, I mean, anything below 7,000 looks unsustainable.
Okay. Yeah, I can imagine. And we have only spoken valuations. We have not yet spoken earnings growth. How are you looking at the earnings growth revisions? What is the FY14 picture? Sorry, FY15 picture? And more importantly, FY16, since you're actually talking about 16 valuations.
See, 15, there won't be much change. Whatever the government does at this point of time, there could be a sentiment change. There could be a little bit of positive impact on a few businesses purely because of the sentiment drive. For example, people who are not spending start spending again. Companies which have put their capex plans on hold can start reviving that in the near future itself. But will that impact the FY15 earnings estimates in a huge manner? I doubt it. So the bulk of the change which actually happened in FY16, maybe it's a bit early to call, but I think, again, whether it happens in 16 or maybe slightly back-ended, second half 16, starting 17, my view is if we look at a slightly longer-term horizon, if we think the government can deliver, which means at least from FY16 or 17 onwards, we should start expecting a 7-odd% kind of GDP growth. Add 6 or 7% inflation, that's 13-14% top-line growth. Add some margin expansion, and we should be able to see 16 to 18% sustainable earnings growth for the market for 4 or 5 years. And that picture is, I think, more important than trying to figure out whether the inflection point is FY 15 or 16 or first half 16 or second half 16 at this point.
So where does one really put their money now in terms of individual stocks, Dhiraj? Because when you look at the way these stocks have moved, I mean, infra stocks are up 80-90% this year, banks are up 50-60% this year. You get a bit nervous, you know, that whether you've missed the bus already. Where do you put money now?
You know, banks, most of the banks, most of the private sector banks, with the exception of probably HDFC Group, even after rising 40-50% this year, is just about at or slightly higher than the high seen in 2007, and it's been 7 years. Most of the public sector banks, despite rising 50-70% from the lows, are probably still 30-50% off the highs. Most of the infrastructure stocks, despite doubling or tripling from the lows, I think are still more than 50% off their highs. So it depends whether you want to see the glass which is 1/3 full from being empty, or it's still 2/3 empty. There's still a long way to go.
Okay, so what are the, say, top 5 sectors for you?
I mean, I won't go so much sector weightage or stock weightage at this point of time. I think you will find stock ideas worth investing in from all the sectors. At this point of time, it might appear that the momentum is more lopsided in one part of the market, but as soon as this euphoria settles down a little bit, it'll be more broad-based in terms of across sectors. I mean, each company, each sector, each stock will move relative to its own earnings growth, its own fundamentals going forward. There was a huge mean reversion trade in the market waiting to happen for a large number of stocks which were at almost like distress valuations to come back to sort of mean valuations. Bulk of that trade might have played out. There might be still a bit more left. Bulk of that trade might have played out. So from here on, it's going to be more bottom up.
All right. One final question then, Dhiraj. The PSU trade, you know, the Coal Indias of the world, etc. Do you think a lot of that is done, or is this just the start of a fresh bull run for many of these PSUs?
I think there could be more upside because what a lot of PSUs have done at this point of time, as I said, they've just sort of mean reverted. So they've come up from, I would say, if not distress, at least extremely cheap valuations to a valuation level where it's okay, it's not expensive. But from here on to move any further, what the government is giving initial signals that PSUs will be given more autonomy, will be made more efficient, there will be less government interference, they'll actually function more like business enterprises. If those things happen, then the valuations can move up even higher going forward. So I think there could be more to come.
Yes, sir. More from the government is what all of us are waiting for, and we will certainly touch base with you as and when we get at least the first bunch of announcements from the government. This is still a hope trade. Well, Dhiraj Agarwal, it was a pleasure speaking with you, but we are taking a rain check to call you back when we get the first bunch of announcements. Thanks a lot for joining us.